All righty, folks, we need to talk about a credit crunch. What is a credit crunch? How you may feel it, how you it might operate around you. In order to do this, we're going to talk to the one and only Anna Kelly. How you doing, Anna?
I'm great. So good to be here.
Yes, thank you so much. So, one of the things that I don't think is getting enough attention is the credit crunch. And let's kind of define what it is, why you and I could see it while others might be missing it. So, Anna, what's a credit crunch in your mind?
Sure. So I think at a high level, and then we can kind of dissect this as we go, is that when you go through big changes, shifts in the economic cycle, you move from an expansion period, you start to have some pain, and then you come down into the trough of the economy, more like a recession. Banks start to normally, in that normal business cycle, start to kind of pull back a little bit because they see that there's layoffs. They're worried that people may default. They start to see that people are prioritizing what they pay. They start to get behind on credit card payments, on installment loans, on house payments, car payments, etc. And so the banks start to say, wait, our risk of default is going up because we're heading into some economic pain. And so what they start to do is they start pulling back on any future loans that they're providing and only really write loans that are really high quality, people that have never missed payments, that have plenty of income to support the debt that they're seeking. And they start to offer less on the value of what you want. So, for example, those of us that are used to, at worst, maybe putting 20% down, 25% down on a property, for example, now banks are saying, hey, we'll lend to you, but only at 60% LTV or 65% LTV. So you have to put a lot more money down, even if you do get those loans. And so we see that at the bottom of almost every economic cycle. You and I have lived through several of those. And we've actually been warning of that for at least a year, as we've been telling people, prepare for a recession. And along with that, the credit markets are going to tighten up. So you've got to really have your financial house in order. So let's pause there, and then we can go deeper into kind of what's happening now.
Yeah, I think there's three things that are happening in a credit crunch, and most people don't see them. The first one is, and you and I existed through the last one, the Great Recession. Banks tighten up their credit standards, right? Not only
Absolutely.
does LTV go from 75 to 60, but the box where they say yes just gets ultra tight. And again, a bank will never say they're not lending because that's their business,
Right.
right?
Yes.
That's what they do. But they'll make it so that no is the most common answer.
For
And
sure. And one
I
of those things for real estate investors that we're often looking at is the debt service coverage ratio. So a lot of investors that are using DSCR loans, for example, generally speaking, in a normal, healthy economy, banks might only require a 1.2 or 1.25% DSCR. So if your, mortgage payment's $1,000, they want the net income before the mortgage to be $1,200 to $1,250 to cover that $1,000. What we start to see in these cycles is that they start to say, wait, you need 135 or 140%. So you must have 1,400 a month in income to cover that $1,000 payment. Or even if you have good credit, it's not going to work. And what that requires you to do is they may say, hey, we're still lending 65%. But if that debt service coverage ratio isn't that new higher number, they're going to lend you even less than that to get the payment down where it needs to be.
Yeah. So I think a lot of people, you're going to, that's probably where the average person will see it. Maybe a month ago, they would get a yes answer. Today, they get a no answer. But I think there's two other sneaky things that most people don't get. And this is why commercial real estate's going to feel it where residential won't. And that is that there will be some owners of buildings, commercial properties, who have never missed a payment, never missed a payment, no threat of missing a payment, but their term is up and they must go
Yes.
refi that loan.
That's where
Uh,
the biggest risk is today, for sure.
yeah, there's going to be operators who fully expect to get a refi yes. And because that banking institution is starving for capital, they will get a no, which
Yes.
will force
True.
them to refi elsewhere. It could force them to do a cash in refi, a cash in refi. Oh, can you imagine
Yes.
doing that? Or they'll be forced to sell. I don't think enough people are talking about this. There could be some forced sellers because you can't refi a loan. You don't want to cash in refi. This is going to happen.
Absolutely. And we'll have to look at what episode and maybe go put it down in the link on the show. But we talked about this a little bit last year because I was starting to sell some properties. And I think you asked me and people were saying, why are you selling properties? You want to hold properties, to have income during recession and to fight inflation. But I knew that I had a lot of commercial loans that would be coming due for refinance. And I refinanced as many as I could, took out equity, but I also needed to have a much higher cash position because I did see back in 2009, several regional banks in my area basically were not doing the refis. So they had customers who were great and they said, sorry, you got to pay off your mortgage. And then
Yeah.
they had a hard time doing that. And I did see people having to actually pay in money to refinance because, for example, I may have gotten a property with an 80% loan. Now, when I need to refinance, they're only offering 65% LTV. So that same loan, they're going, we'll still lend to you, but we're going to lower the LTV. Or they think your property value has fallen. And so they want to maintain the original loan to value at the time of your loan. Or the DSCR doesn't work because their DSCR requirements went up. So the only
Yeah.
way to refinance is for them to say, okay, your $1 million loan, now you only qualify for 800,000 in this market. Therefore, if you want this refi, you've got to bring 200,000 to the table. And so I
Yeah.
sold several properties so that I did the calculation in advance. What happens if I need to refi and my LTV goes down? And I used 65%. And I used a DSCR of 1.4 when I had
Wow.
1.2s and 1.25s because I had seen that happen before. So it was painful for me to have to sell some properties that really were good properties, but I knew this risk because I had been there before. And unfortunately, when it's small properties, so, I'm talking like my 20-unit apartment buildings, my 10-unit apartment buildings. I sold some 4-unit buildings to get cash in case I had to deal with those loans. But when you're dealing with large commercial loans, and I'm going to say large, $1 million plus, because that's large to some people. But I mean, we have some loans that are $40 million loans, $50 million loans. When you have that level of loan and you have to, come up with another 10% down, that's a $10 million cash infusion in order to
Hmm.
refi some of these properties. If it's retail or office and they're not occupied, then they're going to
Oh,
ding the LTV based on lower occupancy than the normal standard,
yeah.
10% vacancy. And that also is going to create tremendous pain. So commercial's a real risk. A lot of operators are going to have no choice but to sell, even though they are
Yeah.
really good operators. And this is important for people to realize. You can be very experienced and very good, but when you have a very rapid shift that nobody expected with rates that have gone up so much in this real credit crunch, it hurts the good, bad, and the ugly. It hurts everybody. It just hurts those with experience and liquidity a little bit less. But it's a real risk to the banking system too, Michael. And that's what people
Hmm.
don't really think about. They're saying, oh, there's risk in commercial loans. They don't realize that everyone's debt is another's liability. I'm sorry, is another's asset. And so the
Yep.
debt on the books of the commercial real estate are the assets of the bank. So if the bank has to write down those loans or they take a loss or the people give them back the property, which is happening all across the country in office today, the banks now have to write down the value of their assets. Well, if their liabilities are still high, they could be insolvent on paper because of
Yes.
loans that they had on the books that go under, and that can cause additional bank failures. And so banks are tightening credit because they don't want to lend you money when they need to hold reserves and assets to help offset some of these losses. So that's the real issue that we're dealing with here that really not enough people are talking about. How big are those loans? How many will default? And how many banks have enough reserves and assets to be able to handle all of those losses?
Yeah. The cash in refi, it's going to be a challenge. And I don't think anybody else is talking about it. Because again, it could
Yeah,
be a great building, could be an experienced operator, bad
absolutely.
timing. And
Yeah. And I can tell you this, just two things, because again, we think of, oh, this is scary, right? Banks won't lend me money. Yada, yada. There's always someone that will lend you money. So you find a great deal, and a great opportunity. You can find the money to take it down, whether it's, hard money, private money, less, a couple of loans. I mean, you can restructure all kinds of things. So when I see these kind of things happening, I think there's huge opportunity coming because a lot of people have to sell really good assets. And so I'm still underwriting deals We've made LOIs in the last couple of weeks on a couple of deals that are really strong properties. And especially if you can find one with a loan assumption where their loans aren't actually coming due, but there's other things in their loans that they're not able to meet those loan covenants, like interest rate caps going up, too high or something like that. So there's huge opportunity to buy properties at a much lower basis today than you could have gotten them before, and then, potentially refi later. But people ask, are we in a credit crunch? You haven't seen it as much in residential, but on the commercial side, it's a significant credit crunch. I mean, we're
Yeah.
building and developing apartments, and there are lenders who have said yes, given a pre-approval, given a term sheet, and then come in and go, guys, we have a problem, and it has nothing to do with you, but you're, $80 million loan, our bank can't do it anymore because we
Mhm.
have to hold more reserves because we have a problem. So we can do it, but we can only give you 50% LTV instead of the 70 that we
Ooh.
promised you. So we're
Yeah.
seeing this over and over and over, myself and also some other operators and developers, that banks that gave a yes answer are now backing off and saying, sorry, we can't do it. So this is happening in real time in the commercial space, and even in multifamily, which are considered much more safe and stable loans than office or retail, for example.
Yeah, and then the last thing to kind of talk about a credit crunch is a lot of the commercial market, certainly over the last 2 or 3 years with syndication and the popularity there, has relied on raising private money or private equity, right? Basically, it's
Sure.
not debt, it's equity. And as we saw with the Houston example, there's going to be more of that to come. And I think I think there's a lot of LPs that are going to get hurt, unfortunately. And then what the trickle down there is in this credit crunch is it will be harder to raise, even for the good operators and the good assets. Just this stories of LPs being wiped out in a moment is going to ripple through the industry. So I think there's going to be a lot less syndicators a year from now than all the rookies that I saw over the last couple of years.
Yes, I agree with you completely there. What we also see at the bottom of an economic cycle is fear, right? And so when economic cycles shift, you have all these things happen that people didn't expect. The economy was raring, everybody's excited. The top of the cycle, as I've said over and over, is the maximum point of risk. It's the bottom of the cycle when everybody's afraid, your competition's gone, your banks are drying up, your equity's drying up. That's the maximum point of opportunity. But you have to have the wherewithal, you have to have the deep bench, you already have to have those, LP investors who've been investing with you, who understand that you've been through cycles, that have the confidence in you and your track record. If you're an LP, if you're a GP that just started out 2 or 3 years ago, you went full cycle and looked like a rock star, but you may not really have the experience to deal with a recession. So your investors are definitely more nervous. Full disclosure, I raise money from LPs, and I'm on a lot of phone calls, kind of talking them through, what the risks are of investing, because there are risks of investing in multifamily, even with a tremendous property, a tremendous location, and a tremendous operator. Everything has risks, and some of those risks are unforeseen, they're outside of our control. But I'm having a lot of conversations with limited partners about how do you still, if you're going to invest in anything, how do you diversify, how do you limit risk, and how do you spread your money across a lot of different things, right? And so if you're a limited partner, don't let the fear keep you from investing and sticking with, really good quality assets and quality markets with quality operators. Just like if you're investing in residential, right? You want to keep investing, but you don't want to go buy a C minus property in a C minus location today. You want to buy, a quality asset in a quality area that's going to be recession resilient. So definite fear. You as an investor, I would just encourage you, don't buy into that. Know it's coming. Know it's going to get worse. When you see defaults, you're going to be like paralyzed. And if you're paralyzed, you'll make some really bad decisions and you'll miss some really great opportunity as well.
Yeah, I think the whole point of this discussion is kind of closing on the silver lining. I think there's going to be
Yeah.
amazing opportunities out there. I think there will be opportunities just to restructure debt, but come in as a strong balance sheet. I think there will
Yes.
be some forced sellers that just have to sell to get out. Also, let's not forget that there's just a natural order of selling. I talk to mom and pop investors all the time. They're going to be selling into this environment, competing with other opportunities. So maybe seller financing becomes a better option. I'm
Yes.
ecstatic for what's coming because we've warned about it
Yes.
and got ready. So yeah, I'm ecstatic for what's coming because I
For
think we're gonna have
sure. I have
two
2
two
commercial
years.
properties that came to me this last week, and they both are offering some seller financing, and so we're working on, trying to structure something that's a win-win, and so, never stop looking, never stop investing, never start thinking the sky is falling, real estate is defaulting, and therefore it's bad. No. When you're in an everything bubble at the top of the cycle, everything starts to look bad at the bottom of the cycle, and you just have to kind of put on that investor hat, long-term fundamentals. Where is their value? Where is their resilience? And just continue to invest and get really creative. So maybe we'll do a show on getting creative, but having resilience, having grit to keep going, and getting really creative on how you structure deals when you find a deal that fits your buy box is really going to help you be successful and potentially make way more money on your investments in this next year or so
Oh
than you
yeah.
actually were able to make, when we were up near the peak.
Yeah, I think when you look back in a decade, the deals that are done the next 2 years will dwarf the quality of the deals done the last 2 years. It won't even,
Yes,
it'll
I
be night
agree.
and day different. Yeah, pretty
Yeah.
amazing. Anna, where can people find you?
Great. You can find me here every week on Wednesday and on my playlist. You can find me on social media, Anna Kelly, REI Mom, and my website, reimom.com.
Awesome.